Support and resistance are key concepts in technical analysis that traders use to identify levels at which a financial instrument's price is likely to experience a reversal or a continuation of a trend. I will be breaking this video into 9 parts. We will be covering all these 9 points, so make sure you stay till the end of this video. Support and resistance levels are important concepts in technical analysis used to evaluate securities by analyzing past prices and volume. Support levels refer to the price at which an asset tends to find buying interest and can be thought of as a floor for the price of the asset. Resistance levels refer to the price at which an asset tends to find selling pressure and can be thought of as a ceiling for the price of the asset. Identifying key support and resistance levels can be helpful in creating a trading strategy. It's important to remember that these levels are not always fixed and can change over time as market conditions change, and to use it along with other technical indicators and fundamental analysis to make more educated decisions. Part 2. The various ways in which support and resistance levels can be identified, such as through the use of chart patterns, trend lines, or moving averages. Chart patterns, such as head and shoulders or double bottoms, can be used to identify potential support and resistance levels in a stock's price. Trend lines, which connect 2 or more price points and are used to identify current trends in the market, can be used to identify support and resistance levels by looking for where the price of a stock repeatedly bounces off. Moving averages, which calculate the average price of a stock over a certain period of time, can be used to identify support and resistance levels when the stock's price is near the moving average and the moving average is trending flat or sloping down. If you want more information on chart patterns, trend lines, and moving averages, please watch these videos. Part 3. The psychological aspect of support and resistance, and how traders and market participants tend to react at these levels. Support and resistance are key concepts in technical analysis that describe the levels at which a security's price tends to experience difficulty moving through. Support is a level at which demand for a security is thought to be strong enough to prevent the price from falling further. Conversely, resistance is a level at which there is thought to be an abundance of supply that will prevent the price from rising further. Traders and market participants tend to pay close attention to these levels, as they can be used to make trading decisions. For example, a trader might buy a security when its price hits a support level, in the expectation that the price will rise. Or, a trader might sell a security when its price hits a resistance level, in the expectation that the price will fall. However, because support and resistance levels are based on past price action, they are not always accurate predictors of future price movements. In addition, traders and market participants may act on their perceived notions of support and resistance, which can cause self-fulfilling prophecies. It's also important to keep in mind that psychological aspect of these two terms. Traders and investors tend to place an excessive amount of weight on round numbers. These levels are often psychologically significant, and traders may make decisions based on this, leading to overreaction at these levels. Part 4. The role of news, events, and economic data in shaping support and resistance levels, and how traders can use this information to make more informed trading decisions. News, events, and economic data can all play an important role in shaping support and resistance levels in the markets. These types of information can affect traders' perceptions of a security's value, which can in turn influence the price. For example, positive news about a company can increase demand for its stock, pushing the price up, while negative news can decrease demand, pushing the price down. Similarly, economic data releases such as GDP or employment figures can have a significant impact on the markets, particularly when the data is unexpected. Traders can use this information to make more informed trading decisions. For example, by keeping an eye on the news and upcoming events, a trader can anticipate when a stock's price may be affected and adjust their trading strategies accordingly. Similarly, by tracking economic data releases and analyzing their potential impact on the markets, a trader can identify opportunities for profitable trades. Overall, news, events, and economic data can have a large impact on the markets, and by paying attention to them, traders can make more informed and potentially more profitable trading decisions. Part 5. Real-life examples of where support and resistance levels were tested and how it played out in market. One example of a stock testing a support level occurred in the case of Facebook Inc. In mid-2020. Facebook stock had a support level at around $140. After a sharp drop due to the pandemic situation, it found support at that level. It bounced back from that level and started to recover. This is an example where support level played an important role, as it provided a buying opportunity for investors who believed that the stock was undervalued at that level, and the stock price ultimately recovered after finding support at $140. It's important to note that this is just one example, and that markets are constantly changing, so past performance may not always be indicative of future results. Additionally, it's important to consider other factors such as the company's financials, industry trends, and overall market conditions before making investment decisions. Part 6. The importance of risk management and position size when trading based on support and resistance levels. Risk management, setting stop-loss orders and limiting the percentage of the account that is risked on any one trade can help protect against large losses. Position size, consider the number of shares or contracts of an asset that are bought or sold in a single trade, and adjust accordingly to minimize potential losses and maximize potential gains. Support and resistance. Keep in mind that support and resistance levels are not exact, and there is always a risk that the price will break through them. In summary, while support and resistance levels can be useful in identifying potential trade opportunities, it's important to always manage risk and consider position size to minimize potential losses and maximize potential gains. Part 7. The potential dangers of blindly following support and resistance levels, and how traders should develop their own approach to identifying and trading these levels. Blindly following support and resistance levels can be dangerous for traders because these levels are often subject to change and can be easily manipulated by market participants. Additionally, traders may develop a false sense of security by relying solely on these levels, and may miss important signals or trends that occur outside of them. Traders should develop their own approach to identifying and trading support and resistance levels. This may involve using a combination of technical indicators and chart patterns, as well as conducting fundamental analysis. Traders should also be aware of the potential for market manipulation and take into account the overall market conditions and sentiment when making trading decisions. It's also important for traders to note that support and resistance levels are not always accurate, and it's important to keep an open mind and be willing to adjust your strategy as needed. Traders should also be willing to take profits or cut losses when the market conditions change. Part 8. Comparison of how different indicators perform at identifying support and resistance levels. Different indicators can perform differently at identifying support and resistance levels. Some popular indicators used by traders include moving averages. Simple or exponential moving averages can help identify support and resistance levels by smoothing out price action and highlighting key levels where the price has reversed. Fibonacci retracement. This indicator is based on the Fibonacci sequence and helps identify potential levels of support and resistance by measuring the size of a price move and projecting it forward. Pivot points. Pivot points are calculated using the previous period's high, low, and close prices, and can be used to identify potential levels of support and resistance for the current trading period. Bollinger Bands. Bollinger Bands are a volatility indicator that consists of a moving average and two standard deviation lines. They help identify potential levels of support and resistance by showing the upper and lower limits of the price action. Trend lines. Trend lines can be used to identify support and resistance levels by connecting the highs and lows of the price action over a specific time period. It's important to note that no single indicator is perfect, and it's often beneficial to use multiple indicators in combination to identify and confirm support and resistance levels. Traders should also keep in mind that indicators are based on past data, and future market conditions may change. Part 9. The role of support and resistance in different time frames, and how traders can use them in combination with other analysis to identify trade opportunities. The time frame in which the trader is analyzing can play a big role in determining the significance of support and resistance levels. For example, support and resistance levels that have been established over a longer time frame, such as several months or years, are generally considered to be more significant than levels that have been established over a shorter time frame, such as a few days or weeks. Traders can use support and resistance levels in combination with other forms of analysis, such as trend analysis, to identify trade opportunities. For example, if the price of an asset is trending higher and then reaches a significant resistance level, a trader may look to enter a short position, betting that the price will fall back down. Conversely, if the price is trending lower and then reaches a significant support level, a trader may look to enter a long position, betting that the price will rise again. Overall, support and resistance levels can be used as a way to identify key levels where the price of an asset is likely to experience a reversal, and can be combined with other forms of analysis to help traders make more informed trading decisions.